This conference will now be recorded.
Good evening. This is Lori Steginga from Foresight Capital Management. Along with me is Dylan Schroeder and Patrick Carney. We wanted to spend a few moments this evening to explain the market and what's impacting it and how our economy here is the United States at this point in time. We felt with some of the recent volatility, everyone would want to hear our perspective. So with that, what we're going to start with is a little bit of the economy. So a little history. In 2023 and 2024, the U.S. market had double-digit gains, which is fairly unique, but we had them back to back. So the market in the S&P 500 last year alone was up 25%. So when President Trump began in January in office, the valuations of the market were high. And a lot of the PE ratios of stocks showed us that. So during the first quarter, it was not unusual for the market to, when it's overvalued, to have a slight pullback. And we saw that starting to happen by the end of March. There was a pullback of about 4%, and it was really nothing to be too concerned about because that's what happens when you get an overvalued market. But then the Trump administration is starting to implement some of the policies that they were voted in on, and one of them was the tariff situation. So recently, the tariffs have started and the negotiations have started, but that has brought quite a bit of volatility to the market. So therefore, we wanted to spend tonight to explain that. The consumer sentiment along with that has fallen to a score of 50. So the consumers in general in the United States are starting to have some concern. And with that, we wanted to, again, spend tonight with you. So what I want to start with is the cloud, or a lot of people that have been with Foresight a long time know what this is. If you look at the top, the smiley face is where the economy is right now. And it is in a positive state. It's in a strong state. We're up in that positive feedback loop. And all the arrows are pointing up, which means that we are in kind of this Goldilocks state, or everything is in a positive mode. So we have unemployment low, which means there's plenty of jobs. There's nearly 8 million jobs that people can get if they want a job. The Y at the top is people that have jobs are still getting raises. In the last few years, the raises have been more than inflation. They've been over 4% raises each year. The corporate profits, the companies are very strong. They're resilient, and they have meet and beat their estimates of revenue and sales. So again, our companies are strong right now, and therefore the consumer also is strong. So all those up arrows where that smiley face is what's occurring right now. And honestly, this is expected to occur for the next 2 or 3 years. We could stay in this kind of positive peak efficiency of the economy. But if you look to the far right, things that cause us to kind of circle around and come down around the right side of the circle is the I, which is inflation, and R, which is rates of interest. And both of those arrows would be up. So things that could take us out of this positive feedback loop is if inflation starts spiking, or if interest rates start rising again. See, right now, the Federal Reserve is trying to lower rates. But if those two things start occurring, then we start cycling out of this positive feedback loop and we'll come around. Now, remember, this whole cloud takes about 7 to 10 years to get around. And we're right now in this peak efficiency. So I want you to start with that thought. The economy is strong in the U.S. So the recent market volatility was surrounded around the announcement of the tariffs, and that was on April 3rd. So Foresight has been studying the market daily And so we watch your accounts. We definitely look at them every day now, and we're staying up on the current events. But each quarter we do tactically rebalance your account. So we are looking at everything constantly. What we have done thus far, and what we did even before tariffs were announced, is we had started to de-risk the portfolios. Even in January, when we came out of a double-digit gain year like that, things were overvalued. We paired off some of the big wins. You want to sell high. So we did remove some of the great wins and brought things back more to normal. But since we saw that the market was starting to ease a little bit this first quarter, we have taken out another 5 to 7% out of the equity side of the portfolios. So where we were a little bit overvalued or over allocated in stocks, we've now pulled that back to more of a neutral or a bond money market weighting. And we've pulled them back to normal weighting. So the conservative is balanced at 50-50%, 50% stocks, 50% bonds. The moderate portfolio is at a 60-40, and the aggressive is back to a 75-25. But what we have seen is that broad diversification is working. It is stemming the downturns, the things that are happening in the market that worries us. Your portfolios are handling this very well. Most of them are taking, half or less than half of the downturn right now. And a lot of it is because of the holdings that we have in there. We have top holdings in there, but we've also kind of reduced the risk a little bit. So we've, quote, de-risked the portfolios. So the U.S. economy remains strong, and it should be very resilient this year and into the future. So we're hoping this volatility passes soon.
And then with that, I will speak to what is the current tariff situation as of today. So the overarching theme is that the proposed tariffs are larger than were originally anticipated, which currently includes a baseline 10% tariff on all U.S. imports and individualized company-specific tariffs, which right now, the big one, the headliner as of today, is China is now up to a maximum 245% tariff as a result of the retaliatory actions of their government. And then we've also seen recent proclamations from President Trump where we've restored a 25% tariff on steel and also elevating to a 25% tariff on aluminum. So the last few weeks, we have seen the market react negatively to this news, and that has resulted in domestic and foreign stocks falling sharply. So what we are seeing now, though, is the ability for stocks to rebound very quickly, as they have, particularly in the last week, due to the negotiation of a 90-day pause on reciprocal tariffs. So the market pullback has caused valuations of companies to fall back in line with more of long-term averages, especially for the Magnificent Seven stocks, which we'll show here on the next slide, that are now at their lowest valuation level since early 2023, before their back-to-back double-digit gain years. So the next slide here shows the valuations of the Magnificent Seven stocks. You can see, first of all, that towards the end of 2024, they were reaching pretty much peak valuations dating all the way back to late 2021, right before the bear market of 22. And then with the pullback that we've seen in the market this year, the valuations are now much more in line with normal historical PE ratios, or price per earnings, kind of in the low 20% range. So those companies in particular that have really led the market over the last few years on the way up have led the market on the way down so far in 2025, but are now looking very attractive due to their valuations, the earnings of the companies, and their ability to, make profits not only internationally, but here in the US. And on the far right-hand side of the slide, you'll see the list of those 7 names as well, that are paramount throughout most portfolios, at least through the exchange-traded funds, or kind of the broad diversification that we have for those holdings. The next slide here also speaks to the opportunities that we see in the market. So this shows historically if the S&P 500 corrects between about 15 to 20%, which we're currently right in that range, really depending on the day, what ends up happening, after the fact. And when these corrections are over, which we're not sure if this one is or not, it really depends on how things shake out here. We could end up seeing a little bit more pressure on the downside. Tariffs could stay on a little bit longer. We'll see what happens. But once the correction does end, typically speaking, you do see some very robust returns following this. So positive the day after, 1 month later on average up, about 7%, 3 months later up about 15%, 6 months later up 25%, and 1 year later typically seeing the market grow or gain by about 30%. So a lot of the best days in the market follow some of the worst days in the market. The next slide here that we'll show kind of speaks to some of that price action we saw, particularly last week. So the market ended up dropping about 10 to 12% in just 2 to 3 days, all the way through the end of the first week when tariffs were announced on April 3rd through kind of the middle of the week. And then exactly a week ago, on April 9th, we saw the market rebound 9.5% in a single day. Now, historically speaking, when that happens, you can look at some of the date ranges there on the left-hand side. There's still quite a bit of volatility in the short term. You look at dates like 1987, the early 2000s, 2008, 2020, very volatile times in the market. But the positive there is if you look 1, 3, and 5 years out from the big price move that we saw last Wednesday, you're typically looking at double-digit returns across the market pretty much unanimously. So it does show us historically that if you ride through this, stay invested, and really stay the course, you're likely to see double-digit gains, in the portfolios moving forward 1, 3, and 5 years out from this point in time. And then to flip it over to Dylan here, we'll kind of talk about what are the important things to focus on right now during this volatile time frame.
Yeah, absolutely. So talking about, again, things important to focus on. I know with a lot of volatility in the market and what the news shows and ups and downs that we see, it is important that through these times, being risk adjusted and globally diversified is very important, especially for the long-term investor. But it's also making sure you're comfortable with your own risk and your own risk tolerance there on your personal investments via your own personal factors. And everybody is different. So one of the things we'll definitely mention here at the end is if you are interested in talking a little bit further about where your risk is at, what you're comfortable with, we're more than happy to set up a meeting there as well. But some more important things to think about: the American companies are strong, just like Lori and Patrick have mentioned. The market's the economy is in a really good spot. And 73.5% of S&P 500 companies reported their earnings above analyst expectations in the last quarter of 2024. That's a really high number. So a lot of companies are doing better than even what the analysts are projecting in terms of what they're earning. 64% of companies reported revenue above those analyst expectations there as well. So a lot of the companies doing quite well, the earnings are doing quite well. And just speaking back to the cloud that Lori mentioned, corporate profits are in a very positive spot. Another important thing to note, the 60-40 blend of stocks and bonds. So that diversified portfolio through a rolling period over a 5-year time frame going back to 1950 has not had a negative rolling 5-year time frame. And the chart here up on the next slide will show a little bit more of those details. So long-term investing, staying invested in the portfolio there as well. And although the consumer confidence has decreased sharply, the last 9 times that this has occurred since the 1970s, the S&P 500 has had an average return of upwards of 24% the following 12 months from that data. So just kind of going back to some of Patrick's notes there about those future returns, not always perfect, but the history has shown us some of those things. So here is, again, that time diversification and volatility of returns there. You can see the 5-year rolling average of the stock and bond portfolio has ranged up as high as 20% or as low as 1% for a 5-year rolling average, but has not gone to a negative territory on any 5-year rolling average since 1950 there. And then the same thing here as well with the consumer confidence in the stock market. You can see some of the past times where consumer confidence has hit that trough, and we may not be in the low or the trough for that consumer confidence index. But the last 9 times it's happened, dated back to the 70s there, that average S&P return upwards of 24%. And it's kind of interesting that at the sentiment peaks, that S&P 500 doesn't quite do as much. So it may not be what feels right, but history has shown that the market does tend to have the ability to rebound. So with that, I'll pass it back over to Lori for our final parting thoughts.
So just in conclusion, what we're seeing is that the U.S. economy remains strong and resilient at this point. It has the ability to bounce back. It's not a time that you want to necessarily pull out of the market. The volatility can be your friend, and it's likely to remain here for a while. So, at that point, we're de-risking a little bit, but we're looking for opportunities also. You want to buy low. You want to, stay in this market and keep dollar cost averaging with your savings. Tariffs are something that the U.S. has in place and has had it for many years, but these are likely to remain in place, and along with some of these negotiations that are occurring. So we're not sure exactly how they're going to end up, but I think tariffs are here to stay in some fashion. It's important to remain invested, as I said, and diversified. Diversification is proving huge benefits right now in stemming the downturns of these volatile times. Foresight remains diligent. As I said, we are doing multiple daily reviews on your accounts and staying up with these current events. And we will continue to look for opportunities. Things that we did do when we did de-risk, we've purchased some gold. And as I said, we've pulled out of some equities and pulled it more into market neutral and things in the bond area that earns interest. So please contact us if you have any further discussions that you would like to have regarding this topic or any other topic. We're here, open ears, and I hope you have a very nice spring coming up. Thank you.